Guys, Google is an incredible, incredible company. I love it. Full disclosure, it's one of the 20 stocks that I want to own for a very, very long time. But unlike most other quote unquote investors out there, and the reason I say investors in quotes, people think that just because you put money into an investment, it makes you an investor. That is not the case. Now that may confuse you. It confused me for a very, very, very long time. But as time went on, I started listening more and more to successful investors. It made a lot more sense to me. So if that's the case for you, keep watching the video, watch other videos of ours, and I guarantee it'll make a lot more sense and you'll become a better investor. So, Mo, What are your thoughts overall on Google as a company? Forget about the stock price, forget about the market cap, forget about anything like that. What are your thoughts on it?
Google to me is synonymous with the internet. When you get to a point where you say, Google something, hey, give me Kleenex, I need a styrofoam cup, you've made it. And when we want to look something up, I don't say go and search this for me. I say Google it.
Well, I don't remember the last time I watched a movie in which they said, hey, I was on Bing the other day and I saw this. It's always...
Or DuckDuckGo.
Oh, that's right. That's Apple's, right?
So I was corrected. I think somebody bought it from them or it wasn't.
Oh, really?
Not Apple's. I know it belonged to them at some point. But, you know, and I look at it from an ad standpoint. I mean, who controls internet ads?
Yeah.
Them.
They absolutely control it.
It's only going to get bigger, I think.
So let's take a couple things to look at for Google. So first off, $1.26 trillion market cap and an enterprise value of $1.34 trillion. Now, if you're new to the channel, this is probably the first time you've heard enterprise value. Essentially, the difference here is debt. This is how much you'd pay for the company if you bought it in full and paid off all the debt. This is what it takes to buy all the shares of the company in full. Okay, so that's the difference here. All right, revenue, $282 billion, profit of $67 billion. A
lot of money.
Yes. But interesting enough, this is actually what I thought would be higher. The gross margin, 56%. Microsoft has like 68%.
Yeah.
So I'm actually surprised it's only 56, but guess what? It's Google. They are doing an incredible job on all search engines. They own the search engine market. I want you guys to understand something that a lot of people don't understand about Google also. Let's go to Google right now and type in something. So let's type in Michigan Wolverines, my school that just won. Okay, bad example. Let's go to type in something else. That's a bad example because it's going to be the news on the sports. Let's type in iPad. Now, 85% of clicks happen in the first three links. Do you see what these are right here? Ad, 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 ad. They know they're getting 90% of their clicks right here. They're getting 85% in these first three things. And you think to yourself, this is the organic searches. No, this is all people who just paid for placing right here. That's it. I mean, look at this. How could iPad have number one placing by Verizon? And number two is Apple. Well, very simply, Verizon pays more than Apple to have that number one spot. That's it. Now, if you go below, the first organic search is Apple. Why? Because it's relevant, it's awesome, etc. But not only that, though, Google does an amazing job of how they charge people for this advertising spot. That's also the big thing. They charge for this. They use your Gmail and figure out what you like. This weekend, you texted me about Peloton. And literally immediately when I went to Google, I started seeing ads for Peloton. It wasn't even it was literally a text.
Yeah.
Paul, did you unplug the Peloton? That's all he asked me. That's it. And immediately, and you might sit there and say, that's Big Brother, that's terrible. Maybe it is.
Big Brother or not, that's great for me from an investment standpoint. That's how I look at it. I look at it and say, okay, maybe it's a little bit scary, but then I'm going to think to myself, ooh, as an investor in Google, that's awesome.
Exactly.
Because they are ad targeting people and that just drives more revenue to the company, more profit.
Exactly.
For my pocket.
Exactly. Now, let's go take a look at our 8 pillars overall in the company.
I also want to say one more thing about this. So Google came out with, so they used to have Google Shopping. It was an exclusive app, but now they do, and they've come out with this new feature, Buy on Google, and they have trusted people. You buy it through here. So where do you think Google's definitely getting a cut of all of this now?
No, they're probably humanitarians and just doing it for free.
Probably, right.
All right.
On to the next point.
So remember, again, if it's confusing, just keep on listening. We try to break this down in our 2,000 other videos, etc. So here's our 8 pillars. There's 2 X's here. Valuation metrics, right? The other ones are all green checks. They have a high ROIC, which more on that in 2 seconds. Revenue growth is positive. Net income growth is positive. Cash flow growth is positive. Very little debt. They can pay off their debt with less than 1 year of free cash flow, which we saw in our market cap versus enterprise value. And they're buying back shares. Now, I will say, buying back shares isn't necessarily a good thing when the stock is expensive. And this valuation metric says it's expensive. but is it really? Now, what's ROIC mean? ROIC is an important factor in a justification for paying more multiple for the company, a higher PE and a higher price of free cash flow. This means they get a 15% return on the money that's deployed to grow the business. That's higher than their weighted average cost of capital because the majority of their money is in equity. Why? Because their debt is so low. There are two ways to fund a business, debt or equity. And the two returns on both of those is your weighted average cost of capital. So if investors need 10% and the bank gets 6%, if it's 50-50 debt and equity, the average is 8%. That means you need to get at least an 8% return on your invested capital in order to grow as a business and make economic profit. Trust me when I say this. If you are staring blankly right now, you are in the same boat as 99.999 other percent of people, as was I when I watched this. But just hear me out here, and I will repeat it slowly. There are two ways to fund a business: debt and equity. Your debt holders require a certain return. That might be 10%. And your equity holders might desire a certain return of 10%. And your debt holders, who are the banks and people who lend you money, might require 6%. Now, if it's 10% and 6%, but in this situation, pretty much all the money here is, since there's such little debt, is the investors. You basically have to clear a 10% hurdle, which is about what the market does overall over long periods of time. Yep. And they're getting 14.5%, which is solid. Yep. And the other thing is, the higher the return on invested capital tends to show a moat. If it's long-term and growing especially, you're going to see a really high return on the money. And Charlie Munger always says that even if you overpay for a company, that doesn't matter grossly how much you overpay. Yeah. What was that, Mo?
Not grossly overpay.
Correct. You should be able to get about this return when you buy the company. So when we do our stock analyzer tool next, and we look at the growth rates, one of the big growth rates isn't just net revenue growth. It's how much can their profit grow based on this number. The higher the return on invested capital, the faster the profit can grow in the future. Mm-hmm. And that's really what matters.
When I was listening to Monish Pabrian, he said one of the big things for him is when he's looking at multi-baggers, number one is looking for a return on invested capital on equity, not on debt. That's what you have here.
Yeah. So you have a lot of equity here. And okay, so let's look at analysts are saying about the company. So right here, we have EPS, earnings per share. They're expected to make 527, and in 4 years, it'll be 920. That's low to mid double digit growth. Okay, fine. Revenue. It's actually going to stabilize here. You're looking at, what is this? Mid to high single digits?
Yeah.
Not much. So remember, if they have a high return on invested capital, they can spit off a lot more cash, and they don't require a lot of money to reinvest back in the business. It allows them then to take that extra cash flow, buy back shares, pay down debt, do other things, pay a dividend, do other things that investors really like.
Right, to increase your value.
And this is the thing that Buffett and Munger really focus on. It's buying better quality businesses, even if it's a higher price, buying better quality businesses. Right. So let's go to the stock analyzer tool and figure out what we should pay for Google. So Mo and I are going to do this separately because we have found that when we do it together, we fight like cats and dogs. Mo once started swinging at me and it got really ugly on screen, on air. So we decided to stop doing that. So anyhow, I'm just kidding. 10 years of analysis. Mo?
Okay.
All right. So I'm looking at profit margin here. I look at profit margin and how consistent it's been over the last few years. And I want to break free cash flow. I tend to do free cash flow margin and profit margin the same. I think Mo would agree with that, especially in a company like this, with how it's consistent it is. Okay.
I'm interested to see your PE and price to free.
Well, I think I'm altering it based on my historical desire for PE. So that's the thing, guys. When it comes to PE, we have to pick a PE for the future. What's it going to be at the end of 10 years? Not what it is today. And obviously it gets bigger and bigger and bigger. It's a more stable company. So Mo, first thing, revenue growth. Give it to me.
4, 7, and 10.
Very close to what I did. I did 4, 6, and 9.
Okay.
All right. What about your profit margin?
23, 23.5, and 24.
So I went a little more conservative on the low side. I did 21, 22, and 23.
Okay.
So not terribly off from Mo. Free cash flow did the exact same thing.
Same thing.
PE.
14, 16, and 18.
I did 15, 17 and a half, and 20. Because even on the low end, I think to myself, this justifies 15 or 16 historical value. Mm-hmm. So if I can buy it for cheaper, great. And then I thought to myself, if it sustains as ROIC, then that should justify a higher price, a higher multiple.
Right.
And then desired return.
12, 13, 14.
Very close. I did 12, 13 and a half, 15 because I did a higher
PE.
I did a higher PE.
Right.
So I went with a higher discount rate.
Right.
On desired annual return, this is essentially your margin of safety. And the bigger your desired return, the bigger your assumptions, the more desired return you should have because it needs a higher margin of safety to be safe.
Right.
So I'm gonna hit the analyze button. The stock is currently at 96. All right. On the low side, it's 63. High side, we're almost there. Middle side, 75.
So I'm there on the high end. It's about $108 low end. 67 and that middle ground is about $85.
So it just goes to show how altering the revenue growth, all these small things made a big difference in price. He had about a 15% difference in my top profit price than his. On the low side, look how close we were.
Yeah, we're really
within
really
5%
right
of each other.
Yeah.
Now, that's the key for looking at these companies. So guys, if you look right here, it's currently my watch list at 80. That means it's going to notify me in the software. And this is what's important, guys. This is our most active part of it. 60% of our page views are on Stock Analyzer tool because our users love it. And they go in our community and they chat about it. They'll take screenshots. Paul, what do you think of this? Everyone, what do you think of my assumptions? And they engage in that conversation. So that appeals to you. Check out everythingmoney.com. For less than $1 a day, you can have this, everything you've seen, plus a ton more. So check it out. Mo, I can't wait to own a ton of Google. It'll happen eventually. The stock was at 150 and now it's 96.
Me too. This is my number one company that I want to own.
It's up there for me.
I own Apple already. That's why I say
mine's
number
Microsoft.
Okay, Microsoft's my number 2.
Yeah. So anyways, guys, thanks very much. Go to check out everythingmoney.com. Talk to you later.